Singapore's central bank has kept its monetary policy unchanged for the fifth consecutive time. It is also revisiting its headline inflation forecast to between 2 and 3%. Now, this is down from the previous 2.5 to 3.5% outlook. Nasyrah Rohim with more.
Singapore's central bank's moves to stay pat on its monetary policy is in line with market expectations. This means that the Singapore dollar will keep its prevailing rate of appreciation. Economic activity with Singapore's trading partners have also been stable over the last few months. Analysts say inflation is still a risk in the second half of this year, and the strength of the Singapore dollar could help limit imported inflation. But one analyst believes the current rate of appreciation may not mitigate rising prices of raw materials.
And that begs the question of, whether the appreciation of 1.5% will fully mitigate the higher commodity prices. Probably not, because we likely will see, as what empirical evidence show, that eventually higher commodity prices will actually be seen from higher import prices in Singapore.
Other factors that could push up inflation include geopolitical risks and higher interest rates over a longer period of time. While some regional economies are boosted by the demand in the tech sector, one market watcher says its long-term benefits have yet to be realised.
A key one here to consider is really in terms of the sustainability of the trade recovery, how sustainable it can be. And for now, not only in Singapore, but in Asia, what we have seen is the trade recovery has been limited to the electronics recovery. And the electronics recovery have been very much limited to the high-end AI-powered chips. So how broad-based that recovery can expand to, when can we see it? I think here there's still a lot of uncertainty.
The Monetary Authority of Singapore, meanwhile, expects core inflation, which excludes private transportation and accommodation, to fall further to around 2% next year.